Welcome back, everyone. Today we're exploring the Greek financial crisis between 2009 and 2012, one of the most dramatic episodes of the European sovereign debt crisis. We'll cover the timeline, the key players, what happened, why it happened, how it unfolded, how it ended, and the countries that were affected. The story begins with the global financial crisis in 2008 and 2009. Greece's economy slowed, its debt and deficits grew, and the markets began to worry. In October 2009, the newly elected government under George Papandreou revealed that the country's budget deficit was nearly 12.7% of GDP, far higher than previously reported. This credibility shock rattled investors. Early in 2010, rating agencies downgraded Greece's bonds. Borrowing costs surged, and the country could not refinance its debt at sustainable rates. Austerity packages were introduced in a bid to reassure creditors. In May 2010, Greece received its first bailout, about 110 billion euros, from the European Union, the International Monetary Fund, and the European Central Bank, collectively called the Troika. The deal required deep austerity and structural reforms. Throughout 2010 and 2011, austerity measures multiplied, protests grew, unemployment soared, and GDP contracted. Social unrest and political instability escalated. By late 2011, debt sustainability concerns persisted. Negotiations for a second bailout began, this time with private sector involvement, where bondholders were asked to accept losses. The crisis engaged multiple parties. Domestically, the Greek government, parliament, and citizens. Externally, the EU institutions, the ECB, the IMF, Eurozone creditors, states like Germany and France, international investors, and credit rating agencies. Greece had run large deficits and accumulated massive debt for years. When the truth came out in 2009, trust collapsed. Bond yields skyrocketed, Greece lost access to markets, and bailouts became the only option. Several factors converged: structural fiscal weaknesses, poor tax collection, overspending, and misreported statistics. Greece could not devalue its currency as a Eurozone member. The global crisis triggered investor scrutiny. Political delays deepened the problems. Mechanically, bond spreads widened, blocking Greece's refinancing. Bailout loans replaced market funding, but with strict austerity conditions. These measures reduced deficits, but also shrank GDP, worsening the debt-to-GDP ratio. By early 2012, Greece received a second bailout involving significant bondholder haircuts. This prevented immediate default, but locked Greece into a prolonged recession. Political upheaval and high unemployment continued for years. Greece was the epicenter, but contagion spread. Portugal, Ireland, Spain, and Italy, the so-called PIIGS, came under market pressure. Core Eurozone states like Germany and France were exposed through their banks. Global markets experienced volatility spikes. The Greek financial crisis revealed the dangers of fiscal mismanagement, weak institutions, and structural flaws in the Eurozone. It showed how transparency, credible statistics, and stronger financial governance are crucial in international finance. This concludes our discussion about Greek financial crisis in 2009 through 2012. See you at the next lecture.